So welcome back everybody to another webinar organized by Princeton's Bendheim Center for Finance. We're very happy to have Chris Sims with us. Hi, Chris.
Hi.
Chris will talk about how to worry about government debt and whether we have to worry at all or not. And before we get started, perhaps I should summarize the results of the poll questions. The first question was, will the US debt to GDP ratio ever reach 200%? And 24% it will never reach it, said. 56% say it will be within the next 10 years, and 20% it will be within the next 20 years. The second question was, how will the US reduce its debt to GDP ratio? And you can ask many multiple choice questions. You can click more than one. So 55% think through economic growth, 65% through higher future taxes, and 37% through spending cuts. And finally, the final question was, how long will the US inflation stay below 2%? And 55% think within the next 5 years. It will only within the next 5 years. Between 5 to 10 years, 37%, and 9% think it takes between 10 and 20 years. Okay, so that's the summary that gives us some background what the audience is thinking in these questions. Before we go to Chris, I will give a brief overview what I'm thinking, and then we move on to Chris. So what's about government debt? So what really matters for the fiscal debt sustainability is the debt service cost and the interest burden the fiscal authority has to bear. And of course, if the interest rate is very low, so if, for example, if R is below G, but then the government debt can actually play a Ponzi scheme or a bubble, so it can roll over its debt all the time. The economic growth rate will be higher than the interest burden, so it's not a big deal to have a huge amount of burden, one might think. But the question is, what is the interest rate, the relevant interest rate when you compare R versus G? Is it just the interest rate you pay on the treasuries, on the government debt? Or what interest rate and how is it determined? So the risk-free rate, as we have mentioned earlier in this seminar series, is typically the time preference rate. So how much you prefer today's utility over future utility, that's the time preference rate rho, plus the expected growth rate times the risk aversion coefficient, or it's the intertemporal elasticity of substitution, 1 over that, that's gamma, minus some precautionary term. The precautionary term essentially is the volatility of stochastic volatility of future consumption growth. And that depends, of course, on the risk aversion and on the intertemporal elasticity of substitution this way. And if the government debt is held in form of money primarily, but then there's also some convenience yield you have to subtract. So on money, there will be even a lower interest burden because you have to subtract some convenience yield. And that's essentially what the interest rate is, the relevant interest rate. But you can see that government debt typically is a safe asset. And if it's a safe asset, it can be used as a good store of value, and hence it carries a lower interest burden for the government. But the safe asset is very valuable if markets are incomplete, and if people have to bear a lot of idiosyncratic risk, so health risk and other risks, then the risk-free rate will be lower because they hold government bonds as a precautionary motive, and this precautionary motive brings then the interest cost for the government down. They want to hold more government bonds just in case if something goes wrong for them, they can sell the government bond and replace the broken washing machine or broken car or do the healthcare expenditures they have to pay for. And that's essentially, the higher the risk, the lower the risk-free rate, and the lower is the expense for the government, the more sustainable is the fiscal debt for the government. If it's held in terms of money, in narrow money, then money serves also as a medium of exchange. It overcomes the double coincidence of wants problem. Then you also have some delta I you can subtract to get even a lower interest rate on the government has to pay on the money, outstanding money stock. This, one might argue, might shrink with fintech and all this, so delta I might shrink over time. So, but the important aspect is that this safe asset status and the money status is to some extent the bubbly feature, so it can burst and can go away. You might lose your safe asset status, and that's a big risk. So when I talk here about the risk-free rate, it's without the danger that this additional services, the service flow you get from government debt and from money is not going away. So I assume this is not going away for certainty, it will stay forever. But it is a bubbly feature and hence it can burst, hence it is risky. So the question is a little bit, what if you want to take a risk management approach on government debt, what is really the risk that the interest rate might spike? So what is the fiscal debt servicing cost? What's the value at risk of that? So that's essentially what a risk management approach would approach that. And then the question is, what is the danger that the bubble will burst? And this creates additional endogenous risk. And how do we price that in, and how dangerous is it? And what factors determine that? And one aspect could be fiscal capacity, the capacity of a government to raise additional taxes. Another aspect is to what extent this danger has knock-on effects on the financial sector, which has to be bailed out and endangers the fiscal capacity. And one might argue when this happens, this bursting happens, there's flight to safety, and it's important to see where is this money or the store of values flying into. And you can see that March 2020 was such an episode. There was a danger that the long-term treasury was actually losing a lot in value. And then it was flying into more short-term reserves and short-term treasuries. And that depends very much relative. What is the alternative store of value or safe asset in a global scale? So if all big economies in the global scale go for high debt to GDP ratios and become less stable, then actually relative to the other economies, the US looks even more sound. So that might be less dangerous in this regard. So if you want to know what happened in March 2020, where was the money flowing into, you can see that there was a lot of foreign investors that were withdrawing, getting out of long-term treasuries and wanting some reserves or short-term treasuries. They wanted a much more liquid cash-like instruments rather than having some 30 or 10-year treasuries. There was a huge flight out of 10-year treasuries. That was already a scare. Of course, the Fed intervened and bought a lot of these treasuries and stabilized the treasury market. You can see that the foreigners did this to a large extent. If you compare the numbers here, mutual funds reallocated as well, and the Federal Reserve, in contrast, stepped in order to fix to take the other side to stabilize the long-term treasury market. And if you look at the mandate of the US Federal Reserve, one of the 3 mandates it also has a mandate to stabilize the long-term interest rate. So what's the difference actually between money and debt? So I mentioned already that money has this additional service benefit that it can be used as a medium of exchange. So it's on top of the store of value, on top of this safe asset feature. It has medium of exchange advantage to overcome the double coincidence of wants problems. So you get this delta I benefit as well. So you get a lower interest rate, but you get this advantage of overcoming the cash advance constraint or money utility function, however you want to model it. But more interesting, I think this goes away with more and more fintech innovations. The more interesting thing, the way I think about money is like a console bond with a floating interest rate. So when interests are paid on the reserves, it's like you pay interest on a bond, but it's a bond with infinite maturity. So the maturity is infinite, but the interest rate sensitivity is 0. So the duration essentially is 0 because it's very short-term interest instrument, but it has a maturity of infinity. And of course, money offers, as I mentioned, this additional delta I benefit. It's interesting in the euro area how to think about this. Is it, a joint liability bond with infinite maturity, but it's not clear what it means if the maturity is infinite. Your obligation essentially is only to pay the interest on it. And that's of course a joint liability, and you can always print it on your own. So in general, you have to worry about rollover risk, but for a console bond, which has an infinite maturity, there's no rollover risk. So the question is, what is the actual maturity of the debt for the US, for example? Do you want to look at the consolidated balance sheet between the Treasury and the Fed? So if the Fed is buying a lot of long-term bonds and replace it with reserves, is this a shortening of the maturity structure of the government debt in the United States? Or is it not, because you treat both entities separately? And that's an interesting question in my view to answer. Do you want to consolidate it and consider both? But then if you consider both, you have to the reserves, you have to essentially treat as infinite maturity rather than, because there's no rollover risk on the reserves compared to Treasury bills. Now, finally, I would like to say that, of course, the Fed is doing huge QE purchase measures, about 120 billion a month, and it's ongoing and it's expected. to go on. That has huge implications for the real interest rate. So if you use the TIPS interest rate and you use the regular Treasury government bond interest rate, so the nominal and the real, you can back out the real interest rate from that, the break-even interest rate. If you look at that, and that's a picture I've taken from Arvind Krishnamurthy's recent presentation, you see that if you take, for example, the gray line, that's the implied real interest rate on the 10-year Treasury, and it's pretty low, it's pretty stable. On the other hand, if you take the inflation swaps implied inflation real interest rate, it's actually went up significantly. Okay, so this shows that actually the fact that the Fed is so active in the 10-year Treasury market is really depressing the real interest rate, or put it differently, it lifts the value of treasuries to a high level. And the question is, what is the real interest rate we should actually look at? Of course, there's also a difference between the TIPS. There's two different, the CPI index or the PCE index. So it doesn't make a difference there too between the two numbers. But there's quite a sizable difference between the real interest rate taking out of the inflation swap market and taking it out from the TIPS and the Treasury market through the break-even point. And that's up for debate, you know, which one reflects more truly the inflation expectations. And we had our survey, you know, when will the inflation expectations hit 2%? Depends very much which market you look at. So more generally, I think we have the challenge is essentially you have two traps. You have the deflation trap. There's a danger that, you know, you get, you know, the deflation trap on the one hand, and liquidity trap, and you have to do something. On the other hand, you might also get an inflation trap, especially given the supply shock we have with the COVID shock. There's also an inflation trap, and I think Chris will talk more about fiscal sector and fiscal dominance and how it threatens potentially the independence of a central bank. And financial dominance might also kick in this aspect. So in particular, if you have many countries in your currency area and one or two countries have fiscal problems, and they might be going subject to some default, but then what do you do that? Should the central bank help out or not? In the euro area, for example, might be very challenging. So essentially you have a narrow corridor right now, avoiding the deflation trap on the one hand and avoiding a potential inflation trap on the other hand. And that's what one has to, it's a challenge for central bankers and also for fiscal authorities to find the balance between the two. So with this opening remarks, I would like to pass on now the floor to the expert, Chris, who has thought a lot about these aspects over many, many years, and is probably one of the highest authorities in this area, because the floor is yours.
So Markus has given a great introduction, and a lot of what I'm going to have to, some of what I'm going to say overlaps with what he said. So this is going to be a simple talk. We'll look at some plots of fiscal ratios, do a little bit of arithmetic, talk about Japan, and then ponder what is to be done. And I have very few slides, so it'll be mostly my chatting about the charts. So this is a plot for the US of marketable government debt over GDP. It used to be that that you would choose marketable debt in the hands of the public rather than total marketable debt when you were looking at government debt, because that would subtract, the big difference there is the debt held by the Federal Reserve. And the Dallas Fed time series on the market value of government debt gives you both figures. But of course, once the Fed starts paying interest on government debt, the notion that you should subtract out the part of the debt held by the Fed no longer really makes sense, because the Fed is simply transforming one kind of debt on its asset, on the asset side of its balance sheet, into another kind on the liability side. And right now the interest rates are not very different on the two. So this is the ratio. It's something you're probably familiar with, at least qualitatively, the ratio of debt to GDP, starting back in just after World War II, when debt was almost 80% of GDP. It came down steadily as a ratio to GDP because GDP was growing well and debt continued to pay a low interest rate, and there was some inflation. It started to rise in around 1980. This is the period of the Reagan revolution and fiscal stances, and abetted also by Volcker's very high nominal interest rates on the debt. Debt to GDP went up, but then it began to come down again with the Clinton surpluses. But now in the last 15 years, and particularly in the last year, the ratio of marketable to debt to GDP has shot up to over 100%. So the question is, how worrisome is this? What are the implications of this very sharp rise, in fact, historically unprecedented rise in the ratio of debt to GDP? So as Markus pointed out, what we really want to think about, you'll see in the press discussions of debt to GDP in which they try to characterize the size of the debt by asking how many years worth of GDP would we have to give up in order to pay off the debt. But that's not the right comparison. That's a comparison of a flow to a stock. What you really want to do is look at the debt service costs as a fraction of GDP. We also know that the theory of optimal fiscal policy says that if all you have to raise revenues is distorting taxes, then in general it's not a good idea to quickly reduce government debt. Even though there's a cost to government debt because you need to apply distorting taxes in order to keep it from growing, in order to service the debt. The cost of making taxes even higher temporarily in order to get them lower in the distant future is not a good trade-off. The optimal thing to do is to keep debt steady and maybe very slowly reduce it over time. So when we look at it in flow terms, this is a plot of the primary deficit that is really very close to net issue of new debt. It's the ordinary deficit, expenditures minus receipts, minus interest expense. It's the flow of payments to holders of government debt. And if you work out the private sector optimization problem, the private sector will want to hold, will hold debt, assuming that the discounted present value of these primary surpluses is high enough to match the outstanding market value of the debt. Now, of course, there's a question of what discount rate you use, and that Markus was talking about that. But you can see here that in the US, since about 1950, on average, the US was running primary surpluses. The average up to about, through the early 2000s, looks like it's about 2 or 3%. It is running, this is primary deficit, so the negative numbers are primary surpluses. There was once previously a very large primary deficit that spiked up. These are quarterly numbers at annual rates. So This is not maybe as high as you might think because it's only a quarterly rate, but it stayed up for for a year or two after that. And one way of reading US fiscal and economic history is that that the big inflation in the 70s followed from this huge fiscal boost. It was not just the size of the boost, but it also reflected a sea change politically in that this big deficit was run by President Ford, a Republican, and it represented the working out of Richard Nixon's statement that we're all Keynesians now. This was proving that there was no party in the US that was dedicated to traditional sound budgeting. But then after this period of the late 70s and early 80s, the US went back to running surpluses, and particularly a very long string of primary surpluses during the high growth years under the Clinton administration. So from this point around early 2000s, looking backward, it looked like it was reasonable to suppose the US on average runs primary surpluses. But then of course we had the financial crisis, which caused a very sharp rise in debt GDP ratio. It rises both because debt went up and because output went down. That was followed by a decline as output recovered in the deficit, but not during this period. We had rapid economic growth, very low unemployment, unprecedented for many years before, low levels of unemployment. And yet we were not going back to running primary surpluses. We were still running primary deficits. And then the pandemic hit, and we're getting a shock to primary deficits that's bigger relative to the amount of debt outstanding. And this is really an important point. The amount of debt outstanding when Ford ran his large deficits was quite low. It was near the bottom of the US debt to GDP ratio time series. Now the debt to GDP ratio was already high, and the amount of increase in it relative to the size of the debt is even larger than Ford's impetus was. So if you think that Ford's very large deficits had something to do with the late 70s and early 80s high inflation in the US, you might be concerned about that we could be entering a period where there would be similar pressures. So how did the period of high deficits and rapid debt growth back in the 70s and early 80s end? Here's one story that's food for thought about how we might get out of this again, or how long it might be before we get out of the period of rapidly growing debt. This is a plot of the ratio of interest expense to total receipts in the federal budget. For a long time, up through the early 60s, interest expenses were between 10 and 15% mostly, began to rise in the 70s, and then through a combination of increased debt and the high Volcker nominal interest rates, the ratio of interest expense to total receipts shot up over 25% for several years. And it was in this period that the US Congress put together rules, budgeting rules requiring that new proposals for expenditure be matched by explanations of where the revenue to cover them was going to come from. New proposals for tax reductions had to be accompanied by explanations of what expenditure reductions were going to balance them. And while these rules were not terribly strictly enforced and the enforcement weakened over time, in this period, they were effective. And so the fiscal situation resolved. And of course, at this same time, in here, the Volcker was raising interest rates very high. Now, you can think of the interest rates as directly having reduced inflation, but one of the lessons of the fiscal theory of the price level is that interest rates, in order for interest rates to increases to have a contractionary effect, they have to be accompanied by offsetting contractionary fiscal policy. And that's what happened in this period. The high interest rates generated very high conventional deficits, not as high primary deficits, of course, because the interest expense doesn't count in the primary deficit. But the focus of the public and the politicians was on the conventional deficit, which was extremely high in this period, and it generated a period of increased fiscal discipline. So we're now back down here, despite the fact that the level of debt is now much higher, because the interest rates are so low. The debt service costs in the last 15 years or so have not gone very far outside the range they were in the pre-70s period in the US. So that if you think that the reason that we won't get fiscal discipline in the US Congress until we get interest expense absorbing on the order of 25% of government receipts, there's still a ways to go. However, because debt to GDP is now so much larger than it was at that time, a given increase in the interest rate has a much larger effect on interest expense as a fraction of total receipts. So we could very quickly get back up to this level or above if the Fed were to see a need to raise interest rates. So now that's sort of laying out the landscape. Markus referred to this notion of zero fiscal cost debt when the interest rate the real interest rate on government debt is below the growth rate of the economy, or the nominal rate is below the nominal growth rate of the economy. It doesn't matter which you look at. That implies that we can issue debt, roll it over forever, in other words, never back it with taxes, and nonetheless the ratio of debt to GDP shrinks over time. However, this reasoning applies to a one-time increase in debt. We're not in a situation where where the government is making one-time increases in debt without accompanying them by increased taxation. We're in a situation where the government is steadily issuing more and more government debt. And then you have to start thinking dynamically. In a steady state version of this reasoning, the debt to GDP ratio, if B is debt and Y is GDP, the difference in the growth rate of debt and GDP is delta, which is a primary deficit, plus R, which is interest expense, divided by debt minus the growth rate. So the condition for no growth in B over Y is that this left-hand side is 0. And that we can take the right-hand side, set it to 0, and multiply it through by B over Y. And we get that the condition is the primary deficit plus interest expense over GDP has to be less than the growth rate times B over Y times the debt to GDP ratio. Now, so you can ask, well, suppose the debt to GDP ratio increases. In other words, suppose we run a deficit. What has to happen on the left-hand side? Well, this relationship, since this is a deficit, that implies an increase in B over Y. If nothing happened to R, interest expense, the increase in B over Y allows larger primary deficits. And indeed, over some range, it's true that the higher the level of B over Y, so long as interest rates stay low, there can be a range over which increased levels of debt allow higher primary deficits as a fraction of income to be consistent with no growth in B over Y. The important point that's missing in a lot of the static discussions of is there any cost of increasing debt, is there such a thing as zero fiscal cost debt, is that interest expense and the interest on the government debt are functions of B over Y. Markus laid out one line of reasoning that explains why the interest rate on government debt can be low. Ordinarily, we expect in growth models, real interest rates to be above the growth rate of the economy. But real interest rates on government debt can be below the growth rate of the economy because of the kinds of arguments that Markus was making about the convenience yield and hedging value of debt. So the one way to think about to recognize that you don't want to take this inequality to be too comforting is to recognize that if there were no interest-bearing government debt, R would just be identically 0. So if we're only talking about the only kind of government debt is non-interest-bearing money, currency, then this is just saying you can run a primary deficit that, of course, in this case has to be financed by money issue. The ratio of that money financed deficit to GDP has to be less than the growth rate of output times the M over Y ratio. So zero interest money is the extreme example of zero fiscal cost debt. You can always issue money and never raise taxes, and people will hold it. However, we know that there is a reason not to issue money at high rates, not to do monetary finance deficits, because doing so results eventually in inflation. And the same reasoning applies here, that attempting to get to a higher B over Y ratio by issuing more nominal debt may leave you in the end with a B over Y ratio that hasn't increased, but a price level that has increased. Eventually, on the poll at the beginning of this talk, there were 3 alternatives listed for how debt was going to be repaid, and they were taxes, growth, and reduced expenditures. But there is another way to pay off at least part of the debt, and that is to allow for inflation. Inflation can, of course, if the debt is has an interest rate that's instantaneously adjustable, as soon as inflation is anticipated, interest rates rise, and you can't therefore reduce the debt that way. But so long as the debt has some maturity, it's possible to essentially tax the holders of existing debt by shrinking the market value of the debt they hold with inflation that was unanticipated at the time that the people bought the debt. And it's arguable that in the current situation, which is much like wartime, where there's unprecedented need for temporary high government expenditures, that the appropriate thing to do is to finance at least some of it with an inflation tax on holders of existing debt. Of course, nobody's talking about doing this deliberately in the US. It might nonetheless happen.
Chris, can I ask a quick question about, if you look at the current COVID crisis, are we more in the one-time increase in debt level, or is it a permanent increase, steady state version you're talking about?
You have a one-time but very large increase in the amount of debt. But if, in order for it to stay one time, there has to be an increase in taxation so that the debt service charges don't rise. You also have to remember, as I think I've already said, R is a function of V over Y. As you try to increase the ratio of debt to GDP, the convenience yield of debt, the gap between the interest rate on government debt and real return on private assets will have to shrink. There has to be some limit to how much debt people want to hold, or some limit to how much debt people will hold without starting to insist that it pay the same return as other assets. So as the debt goes up, the interest rate on it is likely to go up. And in order to keep it stable, that could require a very substantial increased fiscal effort, because as you increase the interest rate on debt, it's not just the new debt that you're paying that interest rate on, it's all the outstanding debt. So the effects on the budget of an increased V over Y, if you're in the range where the increase in V over Y is increasing R, the effect on the budget can be quite strong. So if you're right that an optimal, even approximately optimal fiscal policy would make this one-time, wartime-like pandemic expenditure temporary. The rise in debt would then be sharp, but immediately flatten out. So there would be so that the debt ratio would go up, but it would not keep going up. The question is exactly how does that occur and when does that occur? It certainly will require some fiscal adjustment. Any other questions or comments?
Yeah, so I wanted to ask you, a lot of this low US interest rate is also because there's a lot of foreign demand for US treasuries. And of course, geopolitical uncertainty will help that even more. But how do you see the foreign demand interplaying in this, what you just mentioned, that there's a lot of demand making the interest rate from the US treasuries very low. which helps the US.
It's not only the foreign demand. I mean, you can make yourself worry by asking, suppose that the foreigners decide there is some substitute form of government debt that's as stable as the US.
Yes.
But you can also ask, why domestically are people willing to hold so much government debt? There's a classic paper by Krishnamurthy and Vissing Jorgensen that before the financial crisis estimated an equation relating the return on government debt to the debt to GDP ratio. And it found, as you might expect, that the higher the debt to GDP ratio, the smaller the gap between the return on government debt and the return on private assets. But if you used their estimates, you would have expected that it would seem impossible to have such low interest rates at the levels of debt to GDP we have now. So you have to ask, where did that come from? One answer is that the financial crisis showed everybody that liquidity and safety was much more important than people had thought, because the probability of really bad shocks is higher. Another interpretation is that it's regulation, that stricter regulation of balance sheet has required financial institutions to hold much more government debt than they did before. And that sort of fits the fact that so much of the debt is held in the form of reserve deposits at the Federal Reserve by banks.
So you mentioned financial regulation. To what extent can financial repression help, or do you expect financial repression to help on top of that? And Basu would like to know, you talk a lot about how the high level of debt will affect the interest rate, but what's about the growth rate, G? Can you elaborate on that?
So the question is whether the G will be affected directly by the debt ratio. I don't think there's any effect on G of the level of debt other than through what it requires to happen to distorting taxes. I guess you could argue that when the level of debt gets high, if you want to stabilize it, the problem is not just that you have to cover the interest costs, but the high level of debt could, by requiring you to increase taxes, it could lower G. So that becomes another route by which you could start to worry about.
But it could also, if you have a one-time thing, you can also support the economy and avoid scarring effects. And
yes, I think it's perfectly right that we should be running big deficits now, because there's some so many people are so badly affected, and borrowing from the future to aid people who are badly affected now makes sense. I think if you ask the people, if you could ask the people in the future, they would say fine. It's certainly true that running deficits now helps preserve a higher or less reduced G, and I agree with that. It's just that people talk it's one thing to say we should run deficits now. It's another thing to say we don't have to worry about the level of B over Y because we can always print money and cover it. It's true, you can always print money, and to pay the interest, the US government never has to default. But if it has to print too much government paper, it will eventually result in inflation. So let's talk a little bit about Japan. I've been talking about the relationship between debt and inflation from the standpoint of the fiscal theory of the price level that thinks of price level and inflation determination as ultimately traceable back to fiscal policy. But the fiscal theory of the price level, unlike the monetary theory of the price level, which is basically a one-way causal arrow between the stock of money and the price level, the fiscal theory of the price level is about the balance of expectations of future fiscal policy against current levels of debt. And fiscal actions like running a current deficit, cutting taxes today, expending a lot of money today on the pandemic, these fiscal actions have direct impacts on the current deficit, but they obviously also have impacts on the expectations of future fiscal policy. So this is well as illustrated in Japan. Japan started some years ago with the Abe prime ministership with this notion of Abenomics. It had been at very low rates of inflation and low interest rates for a long time. Abenomics was trying to break that low liquidity trap-like equilibrium. Now, it's formal to the extent that it was written out, that people took a position on what the joint fiscal and monetary policy was. And it did break new ground in talking about fiscal and monetary policy jointly. It was to be a commitment to easy monetary policy combined with what was called short-term fiscal expansion and medium-term fiscal adjustment. So there was a series of consumption tax increases that were rather substantial that had been legislated in place before the Abe administration. And initially there was no explicit claim that these taxes were going to be postponed. The schedule of taxes had a first tax rise shortly after the beginning of Abenomics, and that tax rise was implemented, and it caused a drop in the economic growth rate, and the result was that the subsequent scheduled consumption tax increases have not been actually implemented, but on the other hand, it's never been said that they will not be implemented. There was an announcement at the beginning of Abenomics that the primary surplus was to be in balance, the cut in half by 2020 and the imbalance, I can't remember, by 2024 or something like that. And they backed off the, maybe not publicly, but they backed off the notion that they are going to get to a full zero primary deficit by their target date. But all through this period, the idea that the debt level is too high, the primary surplus is unsustainable, and that there would be fiscal adjustments to expenditures and taxes, and particularly very explicit recipe of taxes, was part of Abenomics. And from a fiscal theory of the price level point of view, that makes it very unclear whether this was an expansionary or a contractionary policy. One way that I find it interesting to think about Japan is to recognize that Japan is an aging society. It has one of the oldest population profiles by age in the world. It has government-funded or subsidized healthcare and government retirement programs, and a lot of individual saving is done through the government's postal savings program. the postal savings is now in a government majority-owned quasi-private entity, but it's still in effect a government-run savings program. So there are a lot of individual holders of Japanese government debt. Now, I know from talking with people in Japan that many people in Japan, probably most of them, are very aware that there is a possible fiscal train wreck in their future, that it's not clear whether the level of medical care that they've got now can be maintained. It's not clear that their retirement can be at the level they expect or they initially expected. It's not clear how heavy taxation will be. So there, in a representative agent model, this would be bad enough. There's a lot of uncertainty about how much of a fiscal cost is going to be imposed. And it appears that the expected value of the fiscal adjustment, which will probably have to be in good part through programs like medical expenditures and retirement. In a world where you don't have representative agents, there are people in different age groups and people with different sources of retirement savings who can be affected very differentially by different government policies. So an individual in Japan has a higher uncertainty about the effects of the government deficit, government fiscal problems in the future on that individual's welfare than a representative agent would. And furthermore, if you ask about the risks here, suppose you are a late middle-aged or elderly, about to retire Japanese person, and you have a lot of savings in the form of nominal assets that are implicitly backed by the government or explicitly. One possibility is that the adjustment in the future will come through drastic cuts in programs that benefit you. But in that case, there will be real taxation, not inflation, and your savings in the form of government bonds will maintain their value. The other possibility is that the government maintains its expenditure policies and inflates away a large part of the debt. It doesn't have to reduce expenditures so much. It doesn't have to increase taxes so much. So the individual is better off from that point of view, but he does lose from the inflation that's required to finance this higher level of expenditures and or lower level of taxation.
So Chris, can I ask a question?
The government debt look like a hedge. The debt loses value if expenditures, if there's little fiscal adjustment, little real fiscal adjustment, so you have inflation financed debt, but in that case you don't, the real cost to you of the fiscal adjustment is smaller. And on the other hand, if there's a stringent fiscal adjustment that keeps the price level, the inflation rate from going up, your nominal savings preserve their value and provide you a hedge against the uncertainty of the future government programs. So I think that
interject a question here. So Arvind was saying, he was talking more about uncertainty about the growth rate. Do you think it's more the aggregate growth rate or the idiosyncratic consumption growth rate you face? Do you think it's more the economic growth rate, or is more the uncertainty about future fiscal measures which affect different peoples individually differently? Or do you think it doesn't really matter where the is it aggregate uncertainty, idiosyncratic uncertainty, and is it more coming from the economic growth rate or more coming from the uncertainty about fiscal measures?
I don't know the answer, but I don't think ordinary people know the answer either. In fact, we're used to breaking up uncertainty into sources. I think the average person thinking about future, about his or her own future, just is very worried and is not sorting through a model in which some of their worries come from aggregate economic growth and some from the fiscal side. I think it's one of the problems with the fact that our fiscal and monetary policy is true. In Japan, they try to be more transparent, but they've maintained this ambiguity about, they will not say, the Abe government has not been willing to say, we are planning to finance some of this debt with inflation. They don't have inflation wrapped into their fiscal projections and its effect on debt wrapped into their fiscal projections. And that means that so an individual trying to forecast inflation doesn't have a message from the government that says we're going to need to inflate and that will pay for some of this debt. If that message were there, the inflation would probably start. People would start trying to unload their JGBs and acquire other assets or spend. But so long as the government is still suggesting that it's not going to rely on inflation, and it's understandable politically why they don't want to say they're going to inflate, because there are all these voters who have large amounts of nominal savings that they're counting on, and they would not like a message that the government is going to finance future fiscal problems by taxing away with the inflation part of their retirement savings.
There's another question by Marco Bassetta, who would like to know, you claim government debt is a safe asset, is so safe, but a recent paper by Zhang, Hannah Lustig and others says actually the payout from government debt is very procyclical. So if you put yourself in the shoes of an investor who buys all government debt, most of the payouts in terms of primary surpluses are coming in good times, and in bad times it goes negative, what you get as an investor. So it carries a huge positive beta. Why is it such a good hedge then, if it carries such a huge positive beta?
Well, I'm talking about a very particular set of kind of uncertainty. It's not really business cycle fluctuations. I'm talking about the potential train wreck in Japan. And there, I think the correlations may be different. But I agree that treating the government debt as not risky doesn't really make sense. I think that a lot of the reason the government debt commands a low interest rate is these liquidity considerations and regulatory considerations, which don't really depend on the behavior of debt as a hedge. So my last slide is what is to be done. I don't have anything on the slide.
Do you have something in your mind?
Well, I think it would be good for economists, at least, even if politicians can't do it, to talk about the extent to which we could use inflation to reduce some of the debt. Of course, for inflation to work, as you pointed out, you need either that you can inflate away the value of debt that was bought at a time when the inflation wasn't anticipated. You can also, as the US did after World War II, you can do what some people argue, that there's financial repression whenever the interest rate on government debt is below the market rate on private assets, but I don't think that's a reasonable definition. There are legitimate reasons why government debt is a very desirable asset for liquidity purposes, and sometimes because of its risk characteristics. What you need is just that if you can make the interest rate on government debt low relative to the growth rate, you can work down the debt, and that can be either through real financial repression, which is requiring banks to buy debt at low interest rates, or other regulatory measures, or it can be just by running your treasury well enough so that people find the debt extremely convenient and are willing to take it at low interest rates. So over the long run, that's what's to be done. For the short run, the problem is how, in the US, can our political institutions rationally deal with this? Do we have to wait for debt service charges to get up to be 25% of revenues before we can expect to get the attention of legislators? And that's a hard question. And it actually, as I said, as I was going through those plots, in our current situation, it doesn't take very much of an increase in interest rates to get us back up to the situation we were in the early 80s, with 25% of receipts being absorbed by interest costs. When congressmen see that, and senators see that, they realize that the resources they have to allocate the way they would like to are being absorbed by these interest costs. And it's not much of a step beyond that to realize that this situation will get worse unless we do something about the size of deficits. But before that, so long as the debts or the interest expense is a very small fraction of the budget, they're just not, I think it's probably true, they will not pay much attention to it. The current, especially in the current atmosphere in which on both on the left and right, you have economists arguing that deficits are not very important. So I think it'll be a while before we get any movement towards reduced deficits in the US. So we're already past 1:30, so we can stop there.
But we have a few more questions I would like to throw at you, if you don't mind. One is, in the poll question, we forgot one option, which is to restructure government debt. And that's, one audience member pointed this out, and Tanvir Akram pointed out that that's exactly because government bonds are a good hedge, because there's no default risk, there's no credit risk. Can you elaborate on that to some extent? When would you allow for default risk? And is this a bad idea in the US, in Europe, or in other countries? What's your take on inflating debt away versus defaulting away, or imposing financial regulation, which is essentially does through financial repression shift the burden on the financial sector?
Yeah, sometimes people talk as if inflation and default were the same thing, but they're very different. The inflation involves no violation of contract terms. The contract has simply said that the holder of the debt is supposed to get some interest and get some principal at certain dates, and they're defined in terms of dollars. And so there's no need for the government to default. It's not going to run out of resources to meet the contract terms, and that means it's not very. Inflation is way less disruptive to financial markets and to investment decisions than an outright default. When you default, you look at what happened in Greece with the default. There was a committee that was meeting over a long period of time to decide whether default had actually occurred. And then there were meetings to decide who was going to get how much. And during all that time, the market in government debt in Greece's access to financial markets were badly disrupted. And in fact, anticipation of default and of its complexity and uncertainty is itself destructive. So I think it's a bad idea for the US to contemplate default. Of course, the more of the debt is held by foreigners, the more a democratic government is going to be tempted to try to default, especially if it could arrange to selectively default on foreign debt. Of course, there's no legal way for it to do that, for the US to do that. And the consequences would be bad. The role of the US as a central currency and the premium on US government debt would be gone quickly if we outright defaulted. So I don't think we should, and it's not likely we will. Of course, in Europe, it's quite a different situation where the governments are writing debt contracts that promise to pay euros, which they cannot themselves directly generate. So that's a very different situation. And there, some kind of default mechanism may even be necessary because countries don't have the option of inflating away debt.
So how would you design this default mechanism?
In Europe?
Yes.
I think it's very difficult, and furthermore, I think ideally you wouldn't design a default mechanism. You would preserve the notion that government debt in all EMU countries is equivalent and pays the same rate, guaranteed by the operations of the ECB, and then have an institution that would have to be politically legitimate. It would be capable of penalizing or in other ways controlling the temptation that would arise in such an arrangement for individual countries to run permanent large deficits and shift the financing burden onto the rest of the EMU. This would be a hard institution to design. I think it would be better than default. But you could also imagine trying to handle the issue by insisting that individual government's debt are not all equivalent. Ideally, then you would need a widely traded euro-valued instrument that had shared backing across the EMU for the ECB to use as its instrument in open market operations. And then you would need some kind of judicial institution that could declare when a government was in default and create some kind of bankruptcy mechanism that would allow restructuring the debt. But restructuring is always time-consuming and messy, and it's hard to anticipate what the outcome of it is. So I think that's maybe a fourth best solution.
Thanks a lot, Chris. Perhaps I can inject one last question, which comes from Simon van Noord, is when you derived your mathematical formula, you didn't input some multiple equilibrium considerations into place. Are there multiple equilibria problems in this equation, or in general, how would you put it in your analysis? Or more broadly, in general, how do you think about the multiple equilibrium story?
Well, there are lots of ways multiple equilibria can arise. Like in Europe, it can arise, of course, via anticipation of default, leading to rises in rates that make the default inevitable. But that's different, I think, than what this questioner was asking. What about you can if the interest rate stays on government debt stays very low over a long range of values of the debt to GDP ratio, then an optimizing government may then you may find, according to that little equation I wrote, more than one level of real debt to GDP that's sustainable. And so you can have low debt to GDP and high debt to GDP equilibria. I don't think this creates, I haven't really worked through a dynamic model that works this all the way out. Well, I have a model on my website that does work out a very specific, simple model in which there are no multiple equilibria. It's a model that takes account of R increasing in B over Y. And in that particular model, there was a unique optimal government solution, and there was no, that set of policy parameters generated no multiplicity in equilibrium. But I think that different versions of the model could generate multiplicity.
Thanks a lot, Chris. It was fantastic to get your wisdom on this important topic. We typically end with a positive note. If you have a quick positive note and saying, oh, we will solve all these problems easily, or with this way, I give you another minute or so.
What is the positive note? Well, for some time before President Trump was elected, I had been arguing that we needed a credible, unbacked fiscal expansion to get growth underway in the US. And we have that.
A shortage of safe assets.
So that's a good thing that we had a period of we have a period of unbacked fiscal expansion. The trouble is the latter part of the unbacked fiscal expansion is in response to a big negative shock. The first part wasn't, and it did seem to accelerate growth. And if it had just kept going, maybe we would have gotten inflation back up to target again. So that's a positive way to look at the kind of chaotic policy that has been followed in the last 4 years.
Thanks a lot, Chris, and I see you around.
Okay.
Hopefully soon, not only virtually.
Mm-hmm.
Thanks.